rally the next day after the hammer. It could, in fact, you know, we can go back. See? This hammer, we went back a slide. Did the market rally the next day? No, but if you're using the law of the hammer support, should you still be in? Yes. Even if it closed down more into the lower shadow, using the concept of the law of the hammer support, would you still be in? Yes. So it's okay for the market to sell off. Nothing wrong with that. The time I would get nervous is if the market closes under the hammer. Okay. This is something that people forget about, that yes, you have a hammer, and the next day the market could sell off. A hammer doesn't mean the next day the market's going to rally. The hammer means it should be a support area. Okay, we saw this before with these lower shadows down here. And normally, just because the market has a series of lower shadows, I wouldn't recommend buying it unless it's, you know, a solid support area there. But the blue arrow points to a hammer. That's one of the reasons the market stabilized. Question?
Go back to that last slide.
Okay, we're going.
Yeah. No, go back. The one that we were using was a different. Yeah. Okay. You have a downtrend, and you had a doji or a spinning top.
Mm-hmm.
3 bars.
Mm-hmm. Mm-hmm.
So wouldn't you already be looking for a reversal at this point?
Yeah, that's a good point. What's happening is, and you can see, let's move this. Okay, so he's saying we have a doji and a spinning top here. Aren't we getting a hint the bears are losing some steam? Yes, but it's still making lower closes. I would be nervous. I would want to see, maybe I'd pull back a little bit on a short position. But didn't we have the same thing over here? Right, okay. So our short-term trend would be down neutral. Our short-term trend here would be down neutral, maybe scaling back a little bit on the short position. Now, boom, that's the confirmation, right? That's the bullish confirmation. Right, now you have a support level, exactly, as he was saying. That's the bullish confirmation to me. So these are tentative clues. These are tentative clues. This is the confirmation. If the market's solid, what should hold as support? The hammer. Question?
If you go back to slide number 28.
Okay.
And let's say you take a long position on the hammer.
Mm-hmm.
And then if you go like 5 and 6 candlesticks forward to the right,
Mm-hmm.
the spinning top on long black candle.
Mm-hmm. Here?
Consider closing your position on that?
No, I move up stops here. I just move up stops. We'll look at stops later. But usually what will happen if the market starts moving and you move moving in a direction, I would immediately move up the stops. This is what the professional traders do that I work with. They'll move up their stops immediately to break even. What I mean by break even, the amount you were willing to risk, I'd move my stop up to that level. So if you were risking 20 or 30 pips, I'd then move my stop to 20 or 30 pips right away. This is a great trade because on this hammer here, although I would view this, and once again on our newsletter, daily newsletter, we'll have different levels of resistance, R1, R2. I would have this as R1 and R2. And I would have a check mark at R2. In other words, it's a more important resistance. So this, if you're buying on this hammer, you might have a little bit of resistance here, but this to me is minor. If you're buying on this hammer, I would have a little longer term target up there. It's a really good risk reward. But getting back to your great question, what if the market is starting to have problems here? Then you may want to think about taking some profits. Nothing wrong with that, or moving up stops. And we're going to look at a technique called adapting to the market a little later. So let me move on. The opposite of a hammer is a shooting star. And this is true for most of the candlestick signals. For every bullish candlestick signal, there's usually a bearish counterpart. And the shooting star, long upper shadow, small real body at the bottom end of the trading range. It's okay to have a little bit of a lower shadow, kind of an upside-down hammer. And the real body can be black or white. And as the Japanese would say, it's signaling trouble overhead. So here we had a shooting star that came after a rally. And here we have a hammer. And you could see with the hammer how it held as a support area. Not surprisingly, the shooting star should be resistance. If the market closes above it, if you're a momentum player, You're looking to buy on strength. You buy on a close above a shooting star. Flip side, if the market breaks under the support of the hammer, your momentum player, you're looking to go short, that's the time to do it. Okay, the shooting star is shown here, should be a resistance area. So if there's a shooting star, and by the time the shooting star is formed, let's say it has an extremely long upper shadow, by the time it's formed, if you have a bad risk reward, you don't do the trade. I think one of the points we had in describing the seminar is learn when to ignore a candlestick signal. The answer is when it's a bad risk reward. So let's say we have a shooting star with an extremely long upper shadow, and at the time it's formed, it's not a good risk reward. How do we use that shooting star? Do we just forget about it? No. You set up a resistance area, an alert system, whatever. Most of the charting packages will give you an alert. You set up the high of the shooting star as an alert, and if you're getting any turning signals at the resistance area, you can think about pulling the trigger from the short side. So here, for example, we have a shooting star as resistance. Okay, I don't know if the doji quite got to it, but the shooting star should be a resistance area. Yes?
32, please.
Mm-hmm. What's that? 32?
Yeah.
Okay.
What is the support level for the after doji? Yeah.
Oh, up here?
No, down there. Yeah.
Down? Over here?
The hammer.
Okay.
Yeah.
Okay, the question is, what is the support area of the hammer? The low of the hammer should be a support area. Okay, if the market closed under it. Okay, so for example, here we have a spinning top and a doji. Did the doji and the spinning tops hold as resistance? You always should use the candles. You can always use the candles to set stop-out levels. So the doji here and the spinning top, did it hold as resistance? Over here? Yeah. You set a resistance area here. Sure it did, right? And once the market got above it, that's a bullish breakout. But this trade probably would have worked out because if you're selling it here, what's your potential target? The recent lows, right? Yeah, it's hard to see the number. Right, but the lows, I don't want to use a laser pointer, but it would be the lows over here.
Yeah.
Right? So, although the market ultimately did break the doji's resistance, pulled back. Okay, so it would have met your target, so that would have worked out okay. But the point here is, once again, emphasizing the importance of using candles as potential stop-out levels. So the low of the hammer should be a support area, and the high of the shooting star should be resistance. So as we move on. Now, what we're looking at now is a combination of kind of a shooting star and a hammer. The hammer has a very long lower shadow. The shooting star has a very long upper shadow. This is called a high wave candle, and what it is a candle line made of a long upper and lower shadows. And what that means is that the market rallies. By the end of the session, the market pulls back. Okay? It sold off. Remember, lower shadow means it sells off by the end of the session. Because if there wasn't a lower shadow, if the market was weak, it should close the black real body, right? So long lower shadow means the market sold off, rallied. The long upper shadow means the market rallied and then sold off. It's totally confused. A high wave candle, the reason I have this slide, the waves of an ocean, the Japanese compare it to the waves of an ocean. The market is really confused. It's totally confused. It goes up, it goes down, it doesn't know what it wants to do. And the Japanese have a wonderful proverb about somebody being confused. Let me see if I remember it. As if his hair is set on fire. Very visual, running around going, oh. So the high wave candle is telling us that the prior, what we do is look at the high wave candle compared to the prior candle. So for example, did the euro here have a sense of direction? Sure. Sure did. Okay. Here, I mean, it's most of the time the high wave candles also have small real bodies. So the small real body is showing us the market could be losing momentum, but these long upper and lower shadows are also showing the market's confused. What does that mean? It means the trend has gone from up to neutral. It's gone from a period where the market knew what it wanted to do, to a time where it doesn't know what it wants to do. What does that do to the probability of the market's turning? It increases, right? It's not 100%, but it increases it. But with this, as soon as we have this spinning top, which is the same as the doji, we set that as a resistance area. Now we have a couple of couple of high wave candles here and over here. And we're going to look at these later because